Hey guys, what's up? I'm Erin and welcome back to the channel. Okay, so this just happened. The Social Security Administration made a huge announcement following the passage of one big beautiful bill. And here's what they said. The bill ensures that nearly 90% of Social Security beneficiaries will no longer pay federal income taxes on their benefits, providing meaningful and immediate relief to seniors who've spent a lifetime contributing to our nation's economy. That sounds like a huge win, right? But what if it's not entirely accurate, and that new deduction that they're celebrating, it's not even tied to Social Security? Here's what it is tied to. It's tied to your age. If you're 65 or older, you're in. It truly doesn't matter whether you've started collecting Social Security or not. Your age is what matters most. But then we also have to say, income matters. It is means tested. There is an income threshold and a phase-out range at a point that you get to where the deduction is completely phased out. For single filers, they can capture the full deduction if their income is $75,000 or less. The phase-out range is above $75,000 up to $175,000. Then once your income exceeds $175,000, it is phased out completely. And for those married filing jointly, they're entitled to the full deduction if their income is $150,000 or less. The phase-out range is $150,000 to $250,000. So once your income exceeds $250,000, you lose the deduction completely. So while this deduction isn't technically tied to Social Security, the Social Security Administration is framing it as a win. They're saying effectively this deduction offsets what you otherwise would have paid on your Social Security benefits. They're not changing the provisional income formula. That's fully intact. And in fact, many seniors will still see a portion of their Social Security taxed on paper. But what they're kind of saying is, don't worry, the tax is now essentially canceled out later by this new deduction. That's a bold claim. And the part that really caught my attention was the Social Security Administration saying 90% of Social Security beneficiaries will no longer owe federal income taxes on their Social Security benefits. 90%. That's a pretty specific number, and that's a number we can reverse engineer to see what income levels they're talking about. So now that we understand what this new deduction is and how the Social Security Administration is treating it as a massive win, let's talk about what it actually does. Because here's the thing. It's a $6,000 per person deduction, or $12,000 for married couples if you're 65 or older and your income qualifies. This is a deduction, not a credit, and that distinction really matters because one of the most common questions or comments I've seen on videos about this goes something like this. If it's a $6,000 deduction, why is it only saving me $600 or $700 on my taxes? So let's break that down. Tax deduction versus tax credit. A tax deduction reduces your taxable income. It reduces the amount of your income that gets taxed. A tax credit, on the other hand, is way more powerful. It reduces your tax bill on a dollar-for-dollar basis. Let's say your income is $50,000 and you're entitled to a $5,000 deduction. Your taxable income then drops to $45,000. And if you're in the 12% bracket, that deduction could save you about $600 in taxes. On the other hand, if we look at a tax credit, let's say you owe $3,000 in taxes, but you qualify for a $1,000 tax credit. Your final tax bill then comes to $2,000. So a credit is much more powerful than a deduction, even of the same amount, right? So this new senior deduction of $6,000 helps, but it's not some $6,000 massive refund. It reduces your taxable income, but then your taxable income then flows to the tax brackets to determine your final tax bill. So let's look at how much you might save based on your income and your filing status with this new senior deduction. For a single income filer, they may save up to $720 if they are entitled to the full deduction, a lesser amount if they're in the phase-out range, and it would have no effect on their taxes if their income exceeds $175,000. For a married couple filing jointly, they may save up to $1,440 if they are entitled to the full deduction based on income. If their income is higher and they're within that phase-out range, they'd save a lesser amount. And for those earning an income beyond $250,000, it wouldn't affect their taxes at all because they wouldn't be able to capture any of the deduction. So yes, this deduction helps, but mentally I keep going back to that statement from the Social Security Administration. This new deduction will ensure that nearly 90% of Social Security beneficiaries will no longer pay federal income taxes on their benefits. Because if roughly 90% of Social Security recipients will effectively have their tax bill from their Social Security benefits wiped down to zero, we can work backwards and ask, what total income level allows this deduction to effectively zero out the taxes they would have paid on their Social Security benefits? Because we know only a portion of Social Security benefits are taxable, and it's based on something called provisional income. So this is where we can reverse engineer it and figure out where this deduction essentially makes it so that you're receiving your Social Security benefits tax-free, even if it's technically taxable on paper. Let's walk through exactly how this deduction works to eliminate your taxes you'd otherwise owe on your Social Security benefits. Because that 90% claim, that is something we can verify if we go step by step. We're going to assume these seniors are taking the standard deduction for 2025, the age 65 bonus deduction tied to the standard deduction, and the new One Big Beautiful Bill senior deduction. Now, after all of these deductions are taken, one still may have a federal income tax bill based on other income sources, but we're trying to nail down that income level where we effectively wipe out the taxes from Social Security. The provisional income calculation does make it a bit tricky, but you can work backwards and figure it out. So here's what I found. For most singles, if your total income, including Social Security and IRA and 401k withdrawals, things like that, is around $63,000, your taxable Social Security is low enough that the $6,000 deduction cancels out the tax. For most couples, if your combined income is around $84,000, your $12,000 deduction is enough to wipe out the taxes you'd otherwise owe on your benefits. So effectively, what the Social Security Administration is saying when they say roughly 90% of recipients will no longer owe federal income taxes on their Social Security benefits, they're saying if you're single and earning $63,000 or less, or if you're married and earning $84,000 or less, while your Social Security may still be technically taxable on paper, this deduction offsets that tax. They're saying it's functionally the same thing as making Social Security tax-free for this income group, just by applying the deduction after the fact instead of changing how benefits are taxed. Now here's where we hit a hiccup. We reverse engineered the math and found the income that lines up with the Social Security statement, but now we've run into something that doesn't quite line up, and this has to do with how we define income and where this data is coming from. So let's talk about this, because if you've been looking at income data over the years, and specifically income data from the Federal Reserve, you might be thinking, wait a minute, the top 10% of seniors aren't making $63,000 a year or $84,000 a year. They're earning way more than that. And you would be right. According to the Survey of Consumer Finances, which is used by the Federal Reserve, a single person aged 65 and older in the 90th percentile earns around $130,000. A household headed by someone aged 65 to 69 in the top 10% earns around $263,000. These figures include everything from wages, dividends, capital gains, business income, IRA and 401k withdrawals, rental income, and Social Security. In other words, it is a comprehensive asset-aware measure of where people stand financially, especially those higher income earners. The Social Security Administration bases its stats on a totally different data source: Current Population Survey, Annual Social and Economic Supplement. And this comes with some serious blind spots, especially for retirees. In many cases, it excludes capital gains. It often misses lump sum IRA or 401k withdrawals. It underreports self-employment and rental income. And importantly, it relies on self-reported survey answers, not verified tax data or brokerage accounts. As a result, many income sources are dramatically undercounted in the Social Security Administration data. So when the Social Security Administration says that roughly 90% of all seniors will no longer owe federal income taxes on their benefits, they're not referring to 90% of all seniors. They're referring to the 90% of seniors defined by the CPS survey data. This data also reports that the median income for a single individual is around $27,000 a year, and the 90th percentile is closer to $55,000 to $60,000 a year. But in reality, many older adults, especially in the top 20% or in the top 10%, have many more resources to draw on in retirement and have more income sources. Here are some of the clearly stated known limitations of the income data used by the Social Security Administration. They undercount retirement account withdrawals, unless they're taken as regular scheduled payments. And according to Barron's, only 16% of retirees withdraw from their retirement accounts on a regular systemic basis. It misses large asset sales, Roth conversions, and one-time income events. It also relies on memory and self-reporting, which leads to underreporting, especially among older adults with more complex financial situations. And this one's huge. A U.S. Treasury study found that the CPS underreported retirement account withdrawals by nearly 60%. When the SSA publishes their chart book based on CPS data, they explicitly define what they look at as income. And they also state total money income does not include capital gains or losses or irregular withdrawals or lump sum payments from IRAs, KEHOs, or 401k plans. In other words, a huge chunk of what could easily be considered retirement income or what could push a portion of your Social Security into a taxable range is completely left out of the Social Security's version of income reality. So let's be clear. This isn't to say that the information we're being given from the Federal Reserve is completely flawless either, but it does highlight an important point. The information we're being given about income, about tax exposure, and about who's affected is based on imprecise and often outdated survey methods. So yes, the SSA's claim that nearly 90% of Social Security recipients will no longer have to pay taxes on their Social Security benefits could be true under their narrow definitions of income, but it doesn't truly depict the broader economic picture, especially for retirees with investments, rental property, or other income sources that simply don't show up in their survey. So here's the bottom line. It is highly unlikely that this new deduction offsets the taxes owed on Social Security for 90% of recipients, at least not in the real-world comprehensive sense. And let's not forget, this deduction isn't even tied to Social Security. It applies whether you're claiming benefits or not. It's based strictly on your age and your income level. So while it may sound great in our press release, the number of retirees who are saving enough from this deduction to completely offset the amount they are paying in taxes on their Social Security benefits is almost certainly much lower than 90%. This tax break is clearly targeted at middle-income seniors. It is not geared towards higher-income retirees, and it's not geared towards lower-income retirees who weren't paying taxes to begin with. That's not a bad thing. This is just what the situation is. And if this deduction applies to you, now is a chance to reduce your tax bill, especially from the years 2025 through 2028, while this deduction is available, unless Congress decides to extend it. Even if your income is in the phase-out zone, you can still save money. And let's face it, in retirement, every dollar matters. This wasn't an outright lie, but it is a carefully framed statement based on narrow income data. And I believe it's more beneficial to present the story more accurately rather than spinning it to make it sound better than it actually is. So if you're eligible for this deduction, claim it and save yourself some money. Celebrate that win. But no, this change does not eliminate taxes for roughly 90% of Social Security beneficiaries. It does soften the blow for many, but the picture is far more nuanced, and I think it's more important that we see it clearly. What are your thoughts? Leave them in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. You ready to settle down? I don't think people would like it if I did the video like this. Do you think you can sit on the couch behind me? What do you think? That's a bold... He's settling down. Lost my spot. Oh, crap. I have like 20 documents open. How many tabs do you have open on your computer? I'm about at 150. I max it out. Let me tell you, there is a max, and I've hit it. I've hit it on my phone, I've hit it on my iPad, I've hit it on my MacBook. Let me know if you've hit it. I don't know these people who have one tab open at a time. I just don't know how your brain works. I admire it, but I just don't have that in me.